Well, while the markets wait for clarity on U.S. tariffs expected to be imposed tomorrow, our next guest believes they could be a positive for investors. To understand why and for his investment picks, joining me from New York now is Jay Hatfield, CEO and Portfolio Manager at Infrastructure Capital Advisors. Jay, first of all, you see a slowing U.S. economy, and you think that things like the DOGE job cuts and indeed the tariffs could make things worse. Why don't we begin there?
Thanks, Paul. It's great to be on. Well, actually, that sort of transitioned over the last week from a forward-looking forecast to more reality. In fact, I would say the current data probably overstates the decline. So Atlanta GDP now, so that's a real-time tracker of U.S. GDP, it declined to negative 2.8, which is a bit of a disaster. After ISM came out this morning, very weak, manufacturing that is, and also construction spending. So the U.S. is in a classic old economy recession. Fortunately, we have a boom in tech investment. So our call is that we're not negative 2.8, which is, as I mentioned, disastrous. We're kind of tracking that 1% to 2% area. And it's worth pointing out that first quarter GDP is actually very unreliable due to not just seasonality, but weather. And obviously, you know this as well. It's been a cold winter in the what we call the Northeast, but in the northern part of North America. Mm-hmm. So that affects some of the data, but it nevertheless validates that the U.S. economy is slowing pretty rapidly.
So with that as the backdrop, what is your outlook on the stock market?
We're still bullish on the stock market. We had this, what might have seemed a ridiculous call when rates were at 480, they were going to go to 375. But the reason I mention that is to get to our 7,000 target, we really need rates to be around 375. You really can't justify a 22 multiple with rates at 4.8, which they were only a month ago. So that's part of the call, but we're neutral in the market right now. We have a 6,000 target for the next sort of month or so till we get clarity on tariffs and but more importantly, U.S. tax policy with regard to corporations, because that underpins our 7,000 target. We're assuming an 18% rate, but there's 1,000 S&P point swing between no corporate tax cut and going to 15. So that's why we're on the sidelines right now, waiting for some clarity on U.S. tax policy.
Right. That was going to be my next question, but I guess you've answered it. You said at one point you were bullish on the stock market. You also said you're neutral on the stock market. It appears to be that you're neutral pending a decision on tax cuts, and you're bullish if those tax cuts get delivered, correct?
Correct. And also, I mean, it's kind of like day trading advice a little bit. Just you don't really want to be too long when it's not earnings season, because then you're just subject to what politicians say, and there's plenty of things they say in the U.S. right now. So you get a lot of volatility, but not a lot of upside. So it's just normal for us to be cautious when we're not in the core earnings season. And that's what gives rise to most of the seasonality, is just simply the lack of earnings flow from the biggest companies.
Okay, you're very critical of the U.S. Fed as currently constituted, and Jerome Powell, the chair of the Fed, for, I believe you believe, mishandling the U.S. economy, correct?
Yes, it's almost like their third mandate is to be behind the curve.
Go ahead. Talk to us more about that.
Well, just they follow an index that's 2 years delayed, and they have this artificial 2% target. So they should absolutely be cutting rates. The market's now assuming they will cut rates, but they're making no acknowledgement of that whatsoever. They've totally misanalyzed the Trump policies. They're actually quite recessionary / deflationary. You know, import taxes are a tax. It's like a sales tax, very recessionary, firing like up to 1 million U.S. federal workers. It does detract from growth. So the Fed's completely misanalyzed the Trump policies. They're also cutting the budget deficit in other ways as well. And so they're really risking a recession. I do think they'll come around. The market does too, which is important because when rates go from 480 to 420, it does provide a stimulus to our housing sector.
Okay, with all of that in the background, and there was lots there, you continue to like some of the big Wall Street money center banks. Goldman and Morgan Stanley are a couple of your top picks, and I assume holdings on behalf of clients.
Yeah, so it's those are the two of the biggest positions in our ICAP ETF. And we do actually, I wouldn't go all in, as we mentioned, we're pretty neutral in the market, but they are high beta stocks, just like technology. So technology is getting crushed today and has been for most of last month. So we do think it's a good entry point, dollar cost average as usual, but those stocks are off of $80, $90 in the case of Goldman Sachs. We're carrying consensus estimates 30% above the street. So we're assuming near peak investment banking. Not right away, but as we get into the second half, all these deals, both on the IPO and M&A side, have a gestation period. That's why investment bankers have jobs. So it's not like there's a new president and then just all the mergers get announced. There's a delay, and we think that backlog is building.
Okay. You also like Amazon, and part of the reason you like Amazon is are cost reductions the company is putting in place.
Yeah, so in particular, like markets we're in now, where tech's really getting smashed, Amazon's kind of like half Walmart and then half AWS, or upside to the AI. But on the Walmart side, or just the retail side, they're cutting costs. They're also doing advertising, which de facto is cutting costs. They're getting more revenue without cost. So we think it's a good story. It's more stable than these super volatile chip companies, but yet has come in. So we do think, again, on a cautious basis, just recognizing we're in this lull in the market, that it's created some better entry points, particularly for Amazon versus Broadcom, because these chip stocks, once they start going down, have a lot of downward momentum.
Jay, thank you so much for this conversation. CEO and Portfolio Manager